So let's talk about inflation and why we have it. If we look at our first slide, you see the CPI numbers that were reported in the last report. You don't need me to tell you that we have high inflation. If you've been to the grocery store, if you filled up your car with gas, you know there's high inflation. And here are the numbers. You can see the stats on your screen. The price increases are obvious. But why? Why do we have inflation? That's what we need to figure out. This is the highest inflation we've seen in the United States in the past 40 years. So this is not a blip or a random fluctuation. Clearly there's something that triggered this. So it merits a closer look. And I think we need to really consider understanding the economics behind it, the balance of supply and demand that has caused prices to shoot up and things to get so expensive that it's affecting people's ability to make ends meet. This next slide here is looking at M1 money supply. And if you notice, since 2020, there's a very strong spike, not so much in the absolute value of billions of dollars, but in the slope of the line. And that's really our primary focus. Is yes, there has been an increase in the money supply since 2014, even going back longer, but in the case of this chart. But the slope of the line is our primary concern. And this is where you see a very strong inflection to the upside. Now, we also know in March of 2020, we were hit with the coronavirus and the pandemic. And that has caused governments not only here, but around the world to need to spend more money. And that's understandable. But if you look at the latter end of that chart, there's an even more aggressive spike that took place after we had the vaccines, after we started to get the virus under control. So it would be disingenuous at best to blame everything on the coronavirus, as much as it would be to blame everything on Putin and what he's doing in terms of the war in Ukraine. The government has clearly upticked the spending at a rate that is unsustainable and at a rate that is far more aggressive than has been done by any previous administration, going back from 2020, at least in this chart, all the way back to 2014. Okay, if we look at this next chart here, this is looking at M2. And just to give you a sense, M2 and M1 are really looking at liquid cash in the economy, your savings account, your checking account. M2 is a little bit broader than M1, but either way, they're reflecting the liquid money supply in the system. Again, you can see the thick shaded vertical line, which is reflecting the period under which we were hit with the coronavirus. And then the yellow portion is thereafter the continued slope of the line. So why have we increased the money supply? That can be a huge political debate for the reasons that the government has chosen to keep printing money and printing it at such an aggressive rate. But let's talk about the impact of that. You see, any asset has a limited supply, and there's a correlation in terms of supply and demand between the value of that asset and the supply that's available and the demand that's there. Assuming the demand remains somewhat constant, if the supply contracts, you're going to have an increase in price. And if the supply increases, you'll have a decrease in the value of that asset. So in simple terms, when we look at currency or money, or the US dollar, as an asset for Americans, it is, in theory, a limited supply. But when the government decides to print money, they are increasing the supply. And when we increase the supply of money available, we devalue the purchasing power of that money. And hence, that's how we end up with inflation. So to illustrate, we would need more dollars to purchase the same amount of goods that we could have purchased a year ago. That's inflation at work. Now, people can argue and say, well, we have inflation because the Fed has stopped buying mortgage-backed securities, or the reining in the amount of mortgage-backed securities that they're purchasing. Yes, that may be true, but those are levers in the system that the Fed uses. Those are tools and the mechanics of how the Fed operates in the economic system in the United States. It's not the root cause. The root cause is, why is the Fed buying more mortgage-backed securities or not buying more mortgage-backed securities? The ultimate result is, as we increase or decrease the money supply, it's going to have a direct impact on the purchasing power of the money. Now notice, I'm not talking about the strength of the dollar. The dollar may get stronger, the dollar may get weaker. That is a ratio between the dollar and another currency. So if we talk about the euro or the yen or the pound or the Deutschmark, those are all currencies that the dollar is measured against. So relative to what happens in Europe and the economic policies passed in Europe in relation to the demand for the dollar, there will be a variation in the ratio between the dollar to the euro, and that's what reflects what we consider a strong dollar or a weak dollar relative to that other currency. However, for us as Americans domestically, our concern also is not only the strength of the dollar or the weakness of the dollar, but the purchasing power of the dollar. And this is our primary concern, and this is what we have seen eroded rapidly over the last year. We've seen it eroded in general since the 1940s and prior, but the rapid increase, and that's what I'm reflecting to you here in these charts, where you see the slope of that line, that's the alarm bell. That's the warning sign of what's happening and what our government is doing, or our politicians, the decisions they're making. And we as voters need to be aware of what's happening. Why, again, not debating whether it's wise or not to spend, because that's a whole nother conversation. But do we need to start becoming more fiscally responsible and not spending money we don't have, and not blindly printing more money with this notion of there's no consequence? There is a consequence. There is no free lunch. The piper will be paid, and we are starting to see that in the form of inflation, and we are now taxing Americans with inflation, and we are taxing future earning Americans, meaning the younger generations that are going to go join the workforce, with the decisions that are being made currently today. In 2000, you could only buy with that $100 in 2021 $60 worth of goods. So you've lost 40% of your purchasing power had you not spent it in 2000. This is a huge erosion of the value of your savings. And just to give you a sense, if you, here in this scenario, you've lost 40% of the value of your money in your savings. If you had lost 50% of the value of money in your savings, which we're probably past now because this chart doesn't go all the way to current time, you would need 100% return to get back to break even. And that's the damaging effect when you erode the value of an asset, is you need a much greater return to get back to break even than the levels at which you lost the value of your asset. So in essence, what's happened here is the savings has been taxed at 40% over the past 2 decades. That's a tax that nobody talked about. That's a tax that no politician announced that they would execute. But yet, not only are you being taxed on your earnings when you earn the money, but you also get taxed when you spend the money through a form of a sales tax. And now you're being taxed through erosion of your purchasing power when you save your money. And then you get taxed if you ever decide to spend that money that has been saved. So the deterioration of wealth in the United States is reaching a rapid pace. You also have a hurdle that is moving higher and higher for the younger generation, where they're going to try and play catch up to the baby boomers in terms of accumulation of assets and accumulation of wealth, and it's going to become much harder. So how did we get here? Many reasons and a long history. But again, in the promise to keep this video high level and simple, back when President Nixon took us off of the gold standard. And what I mean by that is the US dollar used to be pegged to gold. And based on that, there was a limited range in which the dollar would fluctuate. However, the United States needed to keep spending more money than they had more money than the amount of gold that they had. So President Nixon decided to take the United States off of its correlation to the gold standard. And ironically, this was announced as a temporary measure, even though there's been nothing temporary about it. This was a permanent measure that I don't see that will ever go back to having a correlation to the gold standard. So what is the US dollar backed by? Really nothing. Some will say it's the good faith of the US government. Okay, who is the US government? Currently, it's the people that were voted into office. Based on them and our good faith in their decision-making ability and our good faith that they will stand behind the dollar to the ability that they even could, that is what's backing the US dollar. Now, we are surrounded by a protective moat in the sense that the US dollar is the primary currency that all nations use in terms of purchasing oil, in terms of doing transactions. So as long as the US dollar is the world's reserve currency, that's a protective moat. If that ever changes, the United States would be in big trouble. But when we went off the gold standard, it gave politicians the liberty and the freedom to just spend money as needed. So every time we have a government shutdown, instead of getting fiscally responsible and reining in our spending, and instead of stopping putting pork and unnecessary items into bills that are being passed, we just continue to increase the spending, justify it and rationalize it, say what we need to say to get the votes, to get our careers going to the next election, and not looking at the big long-term picture of the impact this is having on Americans. And this is our concern as voters, is the people in office are serving short-term. And their primary objective is to be reelected. And they'll do whatever it takes to make that happen. But that may not be in your best interest, or my best interest, or your neighbor's best interest. So it's something we need to consider. But again, I wanted to highlight why we have inflation, and really the point is as we have a supply of an asset, this being cash, currency, checkings, savings, and that asset becomes more plentiful in supply because we print money, then we have eroded the purchasing power of that asset, and that is true inflation. How can the government stop that? Well, one thing they can do is stop printing. Another thing the Fed is looking to do, and you see this now, is raise interest rates. Well, unfortunately, the United States has backed itself into a corner. As the Fed raises interest rates, it will quell and calm inflation. That is a good thing. But on the downside, we're also in a time frame where the United States has more debt than it has ever had in history. And as we increase interest rates, it makes it harder for the United States to service the interest payments on that debt. So if we increase interest rates too much, we take care of inflation, but then we have a debt crisis for the United States where they can't meet the interest payments of what they owe. And if we do not increase the interest rates so we can continue to issue debt at lower interest rates, well, then we have an inflation problem. And that's the tightrope that the Federal Reserve has to walk. We also have the third dilemma, which is the shrinking population in the United States. So as the population is shrinking, that means there are less bodies, less Americans to carry the debt service that's needed and to pay the income through tax revenue that is needed to run this country. The fewer working Americans, the more the burden is per American. And that's a strain and that's a pressure on the American people. Think about it.